Hey, good morning, everyone. Marty Missouri here, March 5th, 2024, Tuesday, with your midweek stock market update. Clients, it'll come linked to an email. Tomorrow morning is Wednesday's message. We will talk about the notably mixed signals that are hitting the financial markets presently. And this morning just gives us a really good, maybe exaggerated example of how kind of mixed up things are. Everything from Fed commentary to evidence showing up in purchasing managers' indices to the action in the financial markets and so on. But I thought I'd start with just highlighting what we sent out in the written blog this morning. It was just a quick note on the fact that the media is pretty giddy, really trumpeting the new highs recently in the S&P 500, although of course, as we've pointed out multiple times herein of late, the average stock or the majority of stocks aren't at new highs. And Bitcoin really ramping up. Clearly the advent of Bitcoin ETFs has put quite the bid under cryptocurrencies of late, while hardly a mention with regard to gold punching its way into all-time high territory. So that all by itself, kind of the silence around gold really ramping up here of late, has got to have those gold bugs or those gold bulls feeling very good about themselves right here. I.e., long-term tops typically do not occur when upside breakouts go unnoticed, suggesting that the asset in question could be notably underowned still. Now, the following, on the other hand, is the sort of signal you look for when you're concerned that present levels of a specific asset class may be indeed overowned, overexuberant, bubbly, and so forth. So this is The Economist, last issue. How high can markets go? Love the picture there. Folks, there is that magazine cover indicator that many people have pulled out over the years. I think I have in the past as well. That typically when you see stuff like this, it's just a box you check that the end is near. Just like, a number of years ago, there was a picture of the bull on Wall Street laying on his back with a knife in his heart. It was the end of the bull market. I think that marked like the bottom by a day or so. It was, I don't recall exactly, but it was right at the market bottom. And that tends to be how these things work. And you go back historically, right before the 29 crash, a prominent figure said that the market has reached a permanent plateau. You're hearing commentary like that. As I listen to, it's usually Bloomberg in the early morning while I'm just kind of setting things up. It's amazing the bulls who continue to come on. Seems like most firms have end of year price targets in the mid 5,000s for the S&P 500. I'm reminded of where they were going into 2022. They were very bullish, and 2022 was a very ugly market. 2023, they were very bearish, and of course 2023, the market, at least a handful of stocks pushing the indices, had a pretty good year. And here we are in 2024, back to that euphoria. It doesn't mean that it has to go the opposite of what Wall Street strategists anticipate, but they tend to get it wrong pretty notably. And I'm not here to pick on them. I'm anything but a market prognosticator, so we try not to do that. But it is interesting how these folks are either compelled to or paid to come out and give folks forecasts. Probably a contrary indicator, particularly when all the sentiment indicators are pretty frothy, which is how it looks to us right here. So as I've pointed out, the breadth, the technicals, and so forth are very suspect, as are the headlines, at least this one from The Economist. And then on gold, we are actually very bullish long-term, fundamentally, on gold for a variety of reasons, and I'm sure we'll get into those as the months and years unfold. Having said that, and I'll show you a chart here in a minute, we expect lots of volatility as it plays itself out. And right now, the technicals don't look all that great on a near-term basis for gold. But we're holding it in our core, and we will continue to going forward. Okay, so let's just we'll just do what we normally do, starting with the S&P 500. I actually have the hourly chart up here. And folks, going back to mid to late February, you could see this nice uptrend line on the hourly chart, but you could see momentum really rolling over. So this was not a good sign. Now that we've broken down below the uptrend line for short-term traders, and I'm not giving short-term trading advice, not giving advice at all in these videos, but anyway, that would be for some a technical sell signal. And as I speak, the S&P is down on the morning. On the daily chart, we're still continuing in this range right up in here, hitting the upper bound here yesterday. You can see coming off that pretty notably today. Very long, dangerous looking bearish divergences, and this morning now a sell signal on the MACD, but using the same logic I showed you on the 60-minute chart, some short-term traders will wait for a break below that trend line before they start shorting or covering longs. On the NASDAQ 100, or the ETF that tracks it, I've got this chart here that takes us back to the previous all-time high and how that looked. And as I continue to point out, the current new all-time high was looking too much like the old for comfort, at least technically speaking. And here we are breaking down below that uptrend line and testing again that 20-day moving average. So these things break down and you get a little momentum behind them, and we think there's potentially quite a bit lower levels to be traversed here in the major averages. As for the Russell 2000 small caps, continuing to flirt and play with the 50% retracement from the all-time high. So here's 2,000 stocks as a group that are way under their all-time high, with really concerning looking bearish divergences, as you can see right here. As for yields, this is where we kind of get into these mixed signals. We have Raphael Bostic, a voting Fed member this year, who's actually pretty dovish, yesterday coming out and saying, we'll probably see, or intimated that he's thinking they'll see one rate cut a little later in the year and then a pause, and to kind of see how markets and other economic actors and agents react to it. And that's based on the world as he sees it right now. And I think that's maybe causing some consternation in the market a bit. We have the likes of Apple and Tesla showing weak results out of China. That's, of course, a monster market for both of them. That's weighing on those stocks. A lot's been weighing on Tesla for the last year or so anyway. And then we had positive PMIs from the services sector coming out today with ISM and S&P Global, although they were a little off of what was expected, but they're still in expansion territory. Look like inflation is continuing to wane there. You'd think that would be bullish for the markets. So folks, this is actually, today's action anyway, is really what we ultimately expect if indeed the economy is going to roll into a recession. And that's where you actually have yields coming down notably. Today, for example, our long-term Treasury ETF is up 1.15%. That means yields are way down. Typically, that would be very bullish for stocks, the way it's been trading of late, but you can see that's not happening. Now, I still think it's too soon to make that call. I think there's other factors in play right here. But ultimately, the way this plays out is that you get an economy weakening, you get inflation coming down, you have interest rates coming down, but you have corporate earnings coming down rapidly. And that's where you get that last leg, that recessionary leg of a bull market. Again, if indeed a recession is in our future. Today, again, gold is up over 0.5%. I just mentioned what long-term bonds are doing and so on. One day does not a trend make, 1 or 2 days or a week even does not a trend make. But interesting to see what's going on. And I think today we can just sum it up with just very mixed signals out there. And then for the dollar, it was up most of the morning. It's actually down slightly as I speak at you right now. Now, the down makes sense with lower yields. Again, earlier, the dollar was showing a little strength. Now that's where you get a decoupling as well. If the economy is weak and the world's buying treasuries to be defensive, well, then that typically is strong for the dollar. So you tend to see the dollar do well under recessionary conditions, whereas leading into that, it was actually doing well on higher interest rate conditions, making the U.S. attractive from an interest rate differential standpoint. When we get into a recession, the U.S. looks attractive because it's the safest currency, safest haven, if you will, in a storm. And then lastly, as I mentioned, gold. Long-term bulls on gold, but folks, you can see it just pounding its way here into what is now new all-time high territory. But, look at the notable bearish divergences here in momentum and overbought here on the RSI. So it would make perfect sense to see gold pull back a little bit, but if it starts getting more attention and folks begin rotating there in size, well then, you could have one of these charts where ultimately the negative technicals get burned through and so forth. So that's certainly a possibility in the near term. And if we are beginning to slow down in the economy, notably over the next few months, well, I think gold would do relatively well. So folks, again, so much to play out, and I'll be here, of course, once or twice a week with the video commentaries along the way, and of course, what we offer up 2 or 3 times a week on the written commentaries. I'll leave it there. Thank you so much, as always, for watching and listening. Talk to you again soon. Bye-bye.